Clearly from a growth perspective, India, when you look at it, we have come down significantly from the levels which we had projected earlier. And currently the levels of growth are projected between 5.5 to 6, but 6 I think also seems to be on the higher side. 5.5 is what looks to be more closer to us. And clearly the recession in the overseas markets are very clear. And there has been a lot of pumping of money by the external economies, particularly the quantitative easing which has been uh, sanctioned by all these economies are going to be influencing a lot of factors in our economies in the days to go. And also, if you see the world growth, I mean, compared to our growth, probably the world growth is much lower, but within the world growth, there are two zones, which is the US zone and the Eurozone. Eurozone trend clearly is on a downward trend, is on a negative trend actually to some extent. US is positive, but far below our numbers, but still it is a positive number. From an Indian point of view, I think there are key developments which have happened in the last few months. If you have been watching the papers, some of the items which are clearly to put the economy back on growth and back on a fiscal consolidation, and also there was a lot of fear about downgrade of India. Downgrade has got its own implications in terms of the financial sector and the whole economy per se. And clearly in that direction, the diesel price hike, which is one of the initiatives taken, the subsidies on LPG, we are seeing some disinvestments happening on the PSU side. We really have to wait and see how these disinvestments happen. The Hindustan Copper is right now on the block, but let's see how it goes through. There was a lot of concern about the general anti-avoidance rules which was going to come in from the current year, and clearly that has been taken as a positive step by delaying that and making it more, there is a committee which was formed to look at it, and the new rules are going to be framed on that basis, which will, I think, will be more investor friendly going forward. The multi-brand retail and other initiatives, as we saw about insurance and all this, we will probably see that in the current parliament session and others, how much they are able to push through some of these reforms. There was this withholding tax on the external commercial borrowing. When any entity borrows from overseas, there is a withholding tax of almost 20%, which required to be in most of the cases the local borrower has to add that cost as part of his interest cost, and that has been reduced from 20 to 5, which is a welcome step. On the reforms on the energy sector, I think the electricity boards, clearly there has been a certain amount of reform there. There is a restructuring along with some tariff reforms and uh, pricing reforms there. And some of the bills like Companies Bill and amendment to certain Competition Act and etc. We will see lot of these bills being introduced in these sessions in the Parliament, and let's see how it goes through. However, while all these reforms are happening, everyone was very gung-ho, and this thing, the subsequent part of that, probably there is a little bit of feeling that the follow-up on some of these reforms are very slow, and some of them may not get implemented by the government. And clearly, I think the 2G auction we have seen, the numbers have been below expectations. The investment climate is still very weak. There is not much of investment which is happening in the country. And the economic data also continues to be weak. Inflation continues to be high. The IIP data is very poor. And the trade deficit is also widening. What happened when the announcements were made and what subsequently happened can be very clearly seen in this slide, which clearly shows that while the rupee and the markets they responded very positively, and we saw the rupee actually coming off to almost 52, 51.74 levels somewhere in the beginning of October. And now you will see that the rupee has actually gone back, and probably it's also going past the earlier levels. We are almost hitting the levels of 55, half 56. And the stock market, which actually went up, has also more or less maintained, but it's on a downward slope. Regarding the FII flows, again, the month of October saw a very good inflow, and both on account of debt flows as well as on the equity flows. And we could not see that number being followed up in the subsequent months. There are two, now what is the outlook from here? Actually, clearly there are two outlook. One is on the positive side, we can expect some of these reforms to go through, and if they are able to push a lot of these reforms, they can attract a lot of foreign flows into the country, and which will obviously help the exchange rate. It will, if the exchange rate appreciates in our favor, then the subsidy on account of this main imports of petrol and the crude and other will get arrested. And pickup will also help some of the domestic sentiment. The new capex can start happening. Commodity prices obviously will help us if all these reforms happen, the money starts coming in. The trade deficit will can be narrowed down. And obviously, if the US starts growing, if the growth starts happening in US, it will be good for all the economies, including the Indian economy. The negative scenario probably is that we don't end up, we start going down further in the path of lower growth and with high inflation. I think lower growth and high inflation is going to be very, very bad for the country. And fiscal slippages can further lead to the downgrade possibilities, which again will not be very good in the long term. I think this is the number which has been very disappointing, which is the IIP, the Index of Industrial Production. And from very high numbers of, this thing, we have now slipped to almost negative numbers. And clearly, the component of this IIP is the capital segment, capital goods segment, where there has been a deacceleration or a negative growth. And that's really not very good for the long-term growth of the country, because the capital goods and this segment is what creates more employment. It creates more output for the future. And if the investment in this sector has not been happening and it has been degrowing, then it actually impacts the long-term growth of the country. This is another item which has not been coming under control, which is the inflation, and clearly the CPI is very high, and even the wholesale price index is well above the comfort zone of the regulators, and clearly it's a sign of supply-led inflation, and whatever the Reserve Bank could do in terms of hiking the rates and keeping the rates high has not really helped to bring the inflation down in any significant manner. This just shows the data between various countries as to how the real GDPs are and where the inflation are. Ideally, the ideal situation is to have a higher real GDP growth with a lower inflation rate. That is the most ideal economic situation one can achieve. And clearly from that point of view, if you see India, we have a much higher inflation, and real GDP growth is lesser than the real inflation rate. So there are a lot of countries like China, if you look at, for example, the inflation is much lower and the growth rates are much higher. On the liquidity front, just from a purely financial point of view, the liquidity in the system has been continuously negative. What it means is that on a daily basis, the banks are borrowing from Reserve Bank, and the amounts have been ranging from 70,000 crores to almost, currently the amount is about 1,24,000 crores. This is the amount the banks are borrowing every day and putting it back into, repaying it back to the Reserve Bank on a daily basis. And these amounts they borrow against their government securities. And clearly the comfort zone on this account is The Reserve Bank says that it is about 1% of the NDTL, the net demand and time liabilities. The net demand time liabilities is about 65 lakh crores. So 1% of that is about 65,000 crores. So the comfort zone is about 65 or 1,000 crores on either side, on plus side or minus side. But however, the actual numbers have been much higher, and currently those numbers are almost double of that. There are various ways by which the RBI has been putting out liquidity into the system. They have been buying the bonds and releasing the cash in the system. They have been doing a lot of open market operations. They have reduced the CRR. They have also reduced the SLR. But despite all this, the current negative liquidity in the system is quite high. Fiscal slippages, I mean, while the government reiterates that they will reduce the fiscal deficit and they are revising the target, but clearly I think the estimate is about 5.9, 5.6% will be the fiscal deficit, which is very high actually. And to really see the expenditure side, we have actually done more expenditure in the first 6 months than what is budgeted, and clearly the revenue has been short of that. Therefore, you find that the net fiscal deficit has been higher than what has been estimated, which really means that the government will have to borrow more money in the second half of this year to fill up the fiscal deficit, and that will clearly put a pressure on the overall liquidity as well as on the interest rate in the system. How rupee has done, there are two data points effectively. If you see from 1st April to 30th September, clearly most of the economies, they saw their rupee actually depreciating, and we also depreciated in that whole zone, but we depreciated lesser than others. 3.5% we depreciated compared to many others which depreciated much higher. But if you see the number from October to date, we have actually depreciated much higher than many of the economies. And that's a very clear sign that the inflows have actually got impacted, and the growth is coming down, and therefore we are seeing the pressure on the rupee very significantly here. Again, this somewhat related to the exchange rate also, in the sense that if you look at the flows into India, 2011, that is the period where you saw the whole inflows which came in. There was a huge inflow of FDI. I think it's a lot of money came from the BP transaction of Reliance. The current year, obviously, the FII flows in the debt has been quite limited, and even the FDI and FII flows have to improve from this level onward. On the credit side of the bank, if you look at, again, the numbers are very revealing. If you see the growth in the deposits, of the bank have been 1,78,400 crores up to September. The banks increased the deposit level by 1,78,400 crores. But against that, if you see the increase in their credit versus the increase in their government securities, the bank credit increased only by 61,000 crores, and almost 2 lakh crores went into buying government securities. So there is a clear aversion towards credit. The banks were actually putting more money into government securities than extending credit. The trend has somehow changed when you take the data up to November. That means clearly from September to November, there has been some more credit which has been pushed by the banks. And if you see the growth in the deposit is about 3,23,000 crores, and the bank credit is about 1,55,000, and government securities buying has been almost 2,45,000 crores. So clearly, some credit has come in this period, but it's still a long way to go. There is still more preference to buy government securities, in the expectation that the rates will come down, and therefore the banks can sell the securities and make profits when the rates go down. As a result of the lower bank credit, what has happened is that the rates of the bank lending rates have remained more or less unchanged, despite the change by CRR and other rates by the Reserve Bank. So what has really happened is the bank borrowings have come down, and the corporates and others have substituted from the market. This data is very important because if you see the commercial paper, which is the borrowing by the corporates and others from the market, Last year, if you see from March 11 to March 12, the net increase in the commercial paper borrowing was only 10,000 crores by the entire corporate. The current year, if you look at for the till October 2012, the net increase is about 1 lakh of crores. So clearly, there has been a huge borrowing shift from the banking system to the markets, and that number can be seen even in the bond segment, where last year the overall for the full year the increase was 74, and here we have got in the 7 months the increase has been almost 65,000 crores. So there is a huge shift of borrowing from banking system to the market borrowing by most of the corporates which have ability to access this market. So in a nutshell, I think from a GDP point of view, the growth will be there, but the growth will probably be at about 5.5 to 6 they are calling about, but more likely at the 5.5 level. Inflation continues to remain high, and the core inflation should start coming down. Fiscal deficit again will exceed the budgeted estimates, and liquidity is expected to remain in deficit mode. RBI will probably start doing some more OMOs and start injecting liquidity, but the liquidity will nevertheless will remain negative only. And RBI, the expectation probably is that the market expects that the Reserve Bank will start cutting rates from the beginning of the financial year, that is from 1st of January. But that will be more to provide to improve the investment climate rather than on fundamental reasons. On the equity markets, I think in the up to 20th November, if you see from the beginning of this year, the markets have actually grown by 5.5% overall, and if you take the last 5-year growth, it's about 6% is the growth in the census. And on the equity markets, I think there are some good signs and not so good signs. One is that the global liquidity is extremely high, and as we saw that the economies are actually putting out more liquidity into the system, and that's very positive for India. Provided the reforms and others happen, I think India will be a very attractive destination, given the fact that the overall price earning ratio of the market is now less than 13, and this is almost 20% lower